Today, we're going to pull back the curtain on two really important tax rules that came out of the Affordable Care Act. We'll break down how you might be able to get some serious help paying for health insurance, and we'll also dig into a special tax that could pop up if you're a higher earner. Here's what we've got on tap. First, we'll look at the big health insurance puzzle the ACA was trying to solve. Then we'll talk about the tax credit designed to help, the super important and kind of tricky year-end reconciliation, and that surtax for high earners. And we'll wrap it all up with the key things you absolutely need to remember.
So let's kick things off with a big question. What was the problem the Affordable Care Act was even trying to fix using our tax system?
Yeah, this is a big one, right? For so many people, the cost of health insurance is a huge financial stress. And that's really the core issue the ACA tries to tackle, using the tax code in some pretty clever ways to make health coverage more affordable.
Now, you might have heard that the penalty for not having health insurance is gone, and that's true. But don't let that fool you into thinking the ACA doesn't matter anymore. A lot of its key parts are still very much alive and kicking, including some powerful tools to help you pay for coverage and, well, some new taxes to help fund the whole thing.
All right, so how exactly does the ACA offer a direct solution to those painfully high premiums? It all comes down to a really powerful tool called a tax credit.
Meet the star of the show, the Premium Tax Credit, or PTC. The easiest way to think about it is like a subsidy from the government that's specifically designed to lower your monthly health insurance bill. But, and this is a big but, it only works for plans you buy through the official health insurance marketplace.
And you actually get a choice in how you receive this money. Most people go for what are called advanced payments. That's where the government sends the credit straight to your insurance company each month, so you just pay a lower bill. It's instant savings. The other option? You can pay the full price yourself all year and then claim the entire credit on your tax return. Could mean a pretty nice refund.
So who gets this credit? Well, you've got to check every single one of these boxes. And honestly, the two that trip most people up are the first and third ones. You have to buy your plan through the marketplace, and you can't be eligible for affordable coverage through your job or a program like Medicare.
Okay, let's move on, because this is where it gets really interesting and a little risky. If you decide to get those advance payments every month, you're also signing up for a very important job come tax time. This is where a lot of people can get into a bind.
This right here is the absolute most important thing you need to understand. When you sign up for that marketplace plan, you have to guess what your income will be for the whole next year. The monthly help you get is based entirely on that guess. It's not final, it's just an estimate.
So at the end of the year, you have to do something called reconciliation. It's just a fancy word for settling up. You'll file Form 8962 with your tax return, and on that form you compare the advance credits you got all year with the credit you actually earned based on what you really made. It's time to see if your guess was right. And this quote just hits the nail on the head. If you got a raise or a bonus or anything that pushed your income higher than you guessed, well, you probably got too much help. And if that happens, you have to pay it back to the IRS.
Now, there is some good news. For many people, the law puts a cap on how much you have to repay. You can see the limits right here. But, and this is huge, look at that very last row. If your final income pushes you over 400% of the federal poverty line, even by $1, that cap vanishes. It's gone. You have to repay every single penny of extra credit you received. It's a massive financial cliff you really want to avoid.
Okay, let's switch gears. The ACA isn't just about handing out credits. To help pay for everything, the law also introduced a brand new tax, and this one is aimed squarely at folks with higher incomes.
This is the number you need to burn into your memory, 3.8%. This is the rate for something called the Net Investment Income Tax. You'll hear people call it the NIIT.
So what is this thing? Well, it's an extra 3.8% tax that gets tacked on to your investment income. But, and this is key, it only applies if your total income is over a certain amount. The tax itself is calculated on whichever is smaller, your total net investment income or the amount your income is over that threshold.
And here are those thresholds. It's $200,000 for single filers and $250,000 for married couples filing jointly. One really important thing to know is that these numbers are not indexed for inflation. That means they don't go up over time, so as years go by, more and more people are going to find themselves having to pay this tax.
The trick here is knowing what counts as investment income. As you can see, it's stuff like interest, dividends, and capital gains from selling stocks or property. But things like your salary from your job, your self-employment income, and money you take out of retirement accounts like a 401k or an IRA, they are not subject to this tax.
Whew, okay. We've looked at the credit that can help you and the tax that might get you. So what does this all boil down to? What are the most important things you need to walk away with? Here it is, your ACA Tax Survival Guide. First, if you want that credit, you must use the marketplace. No way around it. Second, if you get those advance credits, filing Form 8962 is not optional, you have to do it. Third, and this is so important, if your life changes, you get a raise, get married, tell the marketplace right away to avoid a nasty surprise. Fourth, if you have a high income, keep that 3.8% NIIT on your radar. And finally, don't just ignore a bill for excess credit, the IRS will come for that money.
The bottom line is, the Affordable Care Act makes your health insurance and your taxes deeply connected. Understanding the premium tax credit and the net investment income tax is no longer just for accountants. It's absolutely essential for your own financial health. So the big question is, are you sure your tax situation is in check? Are you getting all the help you're entitled to without setting yourself up for an unexpected tax bill later?